Welcome to Citigold series on all things investing. On this episode of Demystifying Wealth, we are covering leveraged investments. Leveraged investing is when you set out to gain a higher profit by investing borrowed money. Higher profits come in when your return on investment is higher than the interest paid to a lender. Although it can reap higher rewards, as we've learned, higher rewards often come with higher risk. The most common form of leveraged investing is margin lending. The margin refers to the difference between the total value of an investment and the loan amount. Loans are usually provided by brokers and banks and use the equity in an investor's account as collateral for the debt, meaning that you put up money or value in your account as the backup to pay these lenders back should the investment move into losses. How much a lender is willing to provide usually depends on the risk level they are willing to accept. The less risky the asset being invested in, the more leverage the lender is willing to provide. For example, investing in an established mutual fund with a large amount of assets under management or highly rated bonds would more likely garner higher leverage from investors because these assets are relatively low risk. If we break margin lending down to its basics, it involves you investing a principal amount of money and borrowing an additional amount in order to invest a higher sum and reap potentially higher rewards. If your investment increases in value, your gains are magnified because you invested a larger sum with your loan and will therefore get proportionate returns. However, if your investment loses value, the losses are also magnified. This is where margin call comes in. Margin call means, as an investor, you need to add more money or more assets as collateral because initial value of the assets kept as collateral at the time of availing the loan has eroded. This is usually set at around 25% of the principal amount, meaning that once your investment loses 25% of money invested, you must cover the losses to the lender, otherwise the collateral that has been put up to cover the loan can be sold. There are few ways in which to alleviate a margin call. First, you can top up your investment with additional cash to make up for the loss and return the value invested back to its original amount. Second, you can purchase more securities in order to bring the portfolio out of a margin call. Third, you can sell off the collateral to pay your lender and close the loan. This is potentially the costliest option as it results in an immediate loss where the other options keep the investment alive. Other than the margin call, further value erosion can happen if the value of the investment falls at a rapid rate. This is called forced sell and usually occurs when the principal amount erodes by 50%. In this case, the investor has a very limited amount of time to top up the collateral, or the collateral will be sold. Hence the name forced sell. It is not all bad news. It is important to be aware of any investment's benefits as well as its risks. Leveraged investing can be a great tool to magnify your investment, but it can go both ways. So, remember to always diversify your investments and invest wisely when investing with leverage. It is imperative for you to have sufficient knowledge and experience and that you are a savvy investor before delving into the world of leveraged investments. We at Citi simplify investing so you can get started early. Take the first step. Talk to your relationship manager today.